Welcome back to Fin and Future. Have you ever wondered why your grocery bill seems to rise every time you go shopping, or why your savings don't stretch as far as they used to? Today, we're diving deep into a topic that affects all of us: inflation. You might have heard the term thrown around in the news, but what does it really mean for your wallet, your future, and the economy as a whole? Let's break it down. First, let's define inflation. Simply put, inflation is the rate at which the general level of prices for goods and services rises, eroding purchasing power. When inflation rises, each dollar you have buys fewer goods and services. For example, if inflation is at 3%, something that costs $100 today will cost $103 next year. This might not sound like much, but over time, it adds up. Over decades, inflation can dramatically alter the cost of living, impacting everything from housing and education to healthcare and retirement. Now, let's explore what causes inflation. There are several key factors, each affecting the economy in different ways. Demand pull inflation. This occurs when demand for goods and services exceeds supply. Imagine a popular concert where everyone wants a ticket, driving prices up. Similarly, when consumers and businesses are spending more than what the economy can produce, prices rise. This kind of inflation often happens in a growing economy where consumer confidence is high. Money. Cost push inflation. This happens when the costs of production increase, leading to higher prices for consumers. For instance, if oil prices rise, transportation costs go up, affecting everything from groceries to gas. Cost-push inflation can be triggered by events like natural disasters, geopolitical tensions, or supply chain disruptions, making it a more unpredictable and potentially severe form of inflation. Built-in inflation. This is linked to wage increases. As workers demand higher wages to keep up with the rising cost of living, businesses may raise prices to maintain profit margins, creating a cycle of inflation. This kind of inflation can be self-perpetuating, as expectations of future inflation lead to behaviors that contribute to its continuation. So, how does inflation affect your purchasing power? Let's illustrate this with a simple example. In the year 2000, you could buy a gallon of milk for about $2.50. Fast forward to today, and that same gallon costs around $4. That's a significant increase. As inflation rises, the value of your money decreases. This means you'll need more money to buy the same items, impacting your daily budget. But inflation doesn't just affect the cost of groceries, it impacts every aspect of your financial life. Housing costs, for instance, have soared in many parts of the world due to both demand pull and cost push factors. Education expenses have also outpaced general inflation, putting more strain on families and increasing student debt burdens. Healthcare, too, is a sector where inflation often runs higher than the average, driven by advancements in technology, increased demand, and administrative costs. Now let's talk about savings. Many people believe that saving money is a safe bet. However, inflation can erode the value of your savings over time. For example, if your savings account earns 1% interest, but inflation is at 3%, you're effectively losing money. Your purchasing power decreases, even though your bank balance may look healthy. To protect against this, it's essential to consider investing as part of your financial strategy. Historically, stocks have outpaced inflation over the long term, providing a potential hedge. Diversifying your portfolio with assets that typically perform well during inflationary periods, such as real estate, commodities, and if you are in the US, inflation-protected securities like TIPS, Treasury inflation-protected securities, can also help safeguard your wealth. Let's take a closer look at some of these options. Stocks. While stock markets can be volatile in the short term, historically, equities have provided returns that outpace inflation. Companies with strong pricing power, meaning they can raise prices without losing customers, tend to perform well in inflationary environments. Real estate. Property values and rental income often rise with inflation, making real estate a popular investment during times of rising prices. Real assets like property provide tangible value and are often seen as a safe haven. Commodities. Items like gold, oil, and agricultural products can act as a hedge against inflation. When the cost of living increases, so does the price of these basic goods, preserving their value in real terms. Tips. These government bonds are specifically designed to protect against inflation. Their principal value adjusts with inflation, ensuring that your investment keeps pace with rising prices. Another aspect to consider is how inflation affects debt. If you have fixed-rate debt, like a mortgage, inflation can actually work in your favor. As inflation rises, wages typically increase, which can make it easier to pay off fixed-rate loans. Essentially, you're paying back your debt with cheaper dollars. However, variable rate loans can become more expensive as interest rates rise in response to inflation. This means that your monthly payments on things like credit card debt or adjustable rate mortgages could increase, adding to your financial burden. It's crucial to be mindful of the types of debt you carry during inflationary periods. Inflation doesn't just impact individuals, it has far-reaching effects on the broader economy. Central banks, like the Federal Reserve in the United States, closely monitor inflation to maintain economic stability. When inflation rises too quickly, central banks may increase interest rates to cool down the economy. This can make borrowing more expensive, slow down business investments, and potentially lead to higher unemployment rates. On the flip side, low inflation or deflation can signal weak demand, leading to economic stagnation. Moreover, inflation can affect international trade. If one country experiences higher inflation than its trading partners, its goods and services become more expensive on the global market, potentially reducing exports. Conversely, lower inflation can make a country's goods more competitive abroad, boosting trade. So, what can you do to protect yourself against inflation? One effective strategy is to stay informed and proactive about your financial planning. Here are some tips. Regularly review and adjust your budget. As prices rise, it's important to keep your spending in check. Look for areas where you can cut costs and reallocate funds to essentials or investments. Invest in inflation-resistant assets. As mentioned earlier, consider diversifying your portfolio to include stocks, real estate, and commodities. Don't forget to keep an eye on your retirement accounts, ensuring they're structured to withstand inflation. Increase your earning potential. In an inflationary environment, it's beneficial to seek opportunities for wage increases or additional income streams. This could be through negotiating a raise, pursuing further education or certifications, or starting a side business. Pay down high-interest debt. Before inflation leads to higher interest rates, it's wise to pay off any variable rate debt. This will reduce your financial vulnerability as rates rise. In summary, inflation is a critical factor that affects your wallet in various ways, from purchasing power to savings and investments. Understanding how it works and the underlying causes can help you make informed financial decisions. By staying informed, investing wisely, and managing debt effectively, you can protect your financial future against the eroding effects of inflation. What strategies do you use to combat inflation? Share your thoughts in the comments below. If you found this video helpful, don't forget to like, share, and subscribe for more insights on personal finance and economics. Until next time.